Hello ladies and gentlemen, and welcome to another video from Swaraj Finance. Today we're going to cover some important updates and some of the important market movements of the week. So without further ado, let's start with gold, which actually this week made an new all-time high, hitting over $2,080. And I just wanted to give you some analysis on the price movement, what we're seeing, because this could potentially be the last opportunity to jump in if you're looking to take advantage of the next upward movement in the gold market. We see an opportunity coming up. So as you can see on the long-term chart, gold has been forming this nice cup and handle formation, as it's known. This is really just representing long periods of consolidation, creating a strong base, then moving upwards, and then similarly creating another base and then moving upwards. So we've had a couple of years of consolidation in the gold price, absorbing the move from around 2016 up to 2020. The large part of the move came from 2018, end of 2018 to mid 2020, really. Less than a year, we had a large movement from around $1,200 all the way up to $2,000. So such a large movement has to be absorbed, digested, consolidated, which we saw over the last 2 years from 2020 to where we are today. And this bull flag pattern, where you have a parallel channel slightly descending in its angle with resistance on the top and support along the bottom, has been definitively broken out over the last few weeks. And just this week, as you can see, we created a new all-time high, as I said, above $2,080, and the third attempt to test this level above, say, 2075 has been rejected again. We've seen a wick, which is normal, healthy, nothing to be worried about, I don't think. Let's move closer at the daily candlesticks. So you see strong resistance at this, it's the 2050 level, really. And so the day has not been able to close above this 2050 level. So I think in the short term, what would be healthy and normal is kind of consolidate a little bit sideways, potentially pull back to 1950, retest this, what was a resistance trend line, should now become support. So it'd be healthy to come back, test this retrend line, and then move on upwards, and then break out properly on the fourth or fifth attempt. So this is what we see in the gold market, and this pullback to the either around the 1950 level or retesting this trend line, this period of sideward consolidation, could potentially be the last opportunity to buy some of the gold mining equities if you wanted to take part in the what we see as being the next move upwards in the gold price. We would expect considerable gains in the gold miners who will benefit from rising gold price. And it's important to note that once we're off to the races, once we break through the 2050, 2070 level of resistance, this zone of resistance here, we're in uncharted territory, and the movements could be quite violent to the upside because there's no further resistance. And so you could see very quickly, we anticipate, if you just do a Fibonacci level, we'd see the first perhaps resistance coming above 2,350, $60. So that would be a quite rapid movement up to here. We could see some consolidation before continuing up to above $2,800. So these could be big movements and fairly quick movements now that once we break out into new territory, and so this really is potentially one of the last opportunities to jump in on this. And it's similar for silver. So silver has been in a similar pattern, consolidating the upward move from 2020 up until start of 2023. We've broken out of this channel, and we're just having some resistance here. Like gold, we might need to come back and retest this level around the $23, somewhere between 23 and 24, before continuing upwards. And for silver, as you can see on the chart, the movements are more pronounced. The percentage movements, relative movements, are larger than gold once we, and it follows gold. And when we're in a major trend, silver will track gold because they're both historically the monetary metals. Though silver has more industrial use today, they're still considered monetary metals, forms of money in the world. So silver, we do expect silver will have some resistance at this level here, around 30, 35, and then again will move fairly quickly, I guess, up to the all-time high in silver, which is $50, and then we'll have considerable resistance there before breaking to new all-time highs. But we do see that as a inevitable eventuality over time. But just from where we are to the next major movement, which will come probably within 18 months or so, that would be a doubling of the silver price, and God knows what the silver equities would do in such a scenario. So now really, again, just giving some hints here, really, that this pullback in the silver price, this sideways consolidation, whatever we do over the next few weeks, could really be one of the last opportunities to get involved with this move in the silver and gold equities. This is not financial advice, of course. It's just an opinion based on what we're seeing in the markets. You shouldn't make any investment decisions based on what we're saying. You must do your own due diligence. But there you go. This is our financial opinion. So that's an update on the precious metals markets based on what we're seeing. And I'll give a quick update on the broader equities as well while we're here. So if we look at the Nasdaq first, you can see we've had a strong, this is a monthly candlestick, so there's some strong buying now coming. The withdrawal of liquidity and the rising interest rates, which caused a correction in the markets over 2022, is now coming to an end, and the end of the interest rate hiking cycle is being anticipated by the financial markets, commodities and equities both, and so we're seeing liquidity re-enter the markets and a strong trend reversal, strong buying pressure. If we look at the weekly candlesticks, this week we've had marginally green week, but again the end of the week was important because we retested this trend line that we're now is established, and we found strong support. Buying pressure came in towards the end, and so we see a continuation to the upside as liquidity and confidence re-enters the markets, as the interest rate rising cycle slows, and we potentially see a pause in interest rates from the central banks over the coming months. And so all this buying, the re-entering of liquidity is shown in the strong volume on the as buying is happening, is occurring on strong volume. So we expect powerful moves in the equities going forwards. But of course, certain equity certain sectors will be outperforming others, and for that kind of analysis, I mean, you can see some of our videos, but if you become a member on our website, you'll get access to our model portfolio where you can see exactly where we're positioned, all of our holdings. You get buy and sell alerts as we make changes to the portfolio. If you need ideas, guidance, and some inspiration and information going forward with how to position yourself to take advantages of potential moves in the markets we see going forward. So that's the equities. S&P is a similar scenario. We've had a reversal in the trend. We're now establishing an upward trend going forwards, and again, following breakout in this resistance that we're experiencing here, we could see continued buying going forward. So lastly, I'll quickly go through oil. If you've seen some of our other videos, we're quite bullish on oil based on various valuation metrics, and there's been a lot of negative sentiment in the oil markets recently, especially because we've pulled all the way back from the high of the summer of 2022 over the last year, almost a year exactly now, from 120 all the way we pulled back to 63 I think we hit, which is kind of a halving of the oil price, and naturally many of the oil explorers and producers have experienced significant drawdowns over this period. However, we are in a rising trend, and if you're an investor, you'll understand that this is a long-term game, investing, and we're clearly in a rising trend. The lows that we've seen have not been lower than previous lows. We're still in a rising trend, and we've found strong support. So this strong buying towards the end of this week, that was very important in the oil market, showing that we're potentially going to see a reversal from here and some upwards, some buying coming in. So it was an important week for oil. Also, if I look on the monthly candlesticks, you see strong buying coming in towards the end of the month, indicating that really the oil market wants to head upwards eventually. But it's been emotionally a strain for people who are invested in the oil markets, which we are. But I'm kind of here to say that everything remains intact for the oil bull thesis, and the demand story, the supply story, the fundamentals. If you look at valuations, I'll quickly, if we look at the energy sector against the S&P on a relative valuation basis, you can see that the oil, the energy sector as a whole, has been, when we were in a bull market for oil during the early 2000s, the energy sector made up almost 7% of the S&P 500. Then it consolidated around the 5% level over the next few years. Then we've had this boom in the US shale industry, where we had a surplus of oil production, and so a decline in the oil price, and the oil sector has fallen all the way back down, almost less than 1% of the whole S&P 500. And if you think about it as an economy, to have energy, which is the driving force of an economy, to whether it be technology, whether it be industry, whether it be services, goods, food, agriculture, all aspects of the economy require energy, through electricity, through oil, transportation, whatever it may be, machinery. Oil is the heart of the and natural gas, the energies more broadly are at the heart of the economy. And so for energy to be 1% of the S&P 500 makes no sense. And so we've seen energies come back up after the COVID lockdowns and that crash that we saw in the oil price. But we're still hovering around levels just under 2% of the S&P 500, which is where we were sat in 1999, 2000, just before the major upward leg in the oil price and the energy sector broadly. So we went from 2% to 7% in the previous bull market as energy outperformed the S&P 500 and normalized to a higher ratio of the S&P 500. And so we'd expect something like that to happen. We have this trend line to break out of before we do so. But it would only be normal and a recourse to what we've seen over history for the energy sector and the oil price to move upwards, really, as energy deserves to be a much higher percentage of the S&P 500 if we want to continue growth. And of course there's talk of a recession, which is why the oil price has suffered recently, scares of a recession. However, the important aspects, things like global flights are increasing, returning to what they were in 2019. China's the lockdown policies and so on have been removed. More and more people will be traveling to places like China, Japan, as restrictions have fully disappeared now. So, and air travel is one of the important demand factors in terms of the oil price. Demand for jet fuel and flights globally is very important. So, and of course, China's economy opening up is important as well, because China's population, India's population, these two in particular are the most populous, and their economies are important in the demand factor for oil. So yeah, we're still sitting at very low levels for the energy sector, still around 2%. To kind of normalize, we'd expect at least a doubling of that in due course to around 4%. But nothing is guaranteed, of course. You can just see that we're on a historical basis, the energy sector is still very cheap relative to the S&P, and it's similar if we look at the energy sector versus the Dow Jones industrial average, so we expect outperformance from the energy sector going forwards. So that's all I wanted to leave you with this week. Kind of started with the precious metals and expanded into some other areas of the markets, more of a broad weekly update. I hope you've enjoyed the content. If you have, please like the video, comment and share with anyone who you think might be interested. If you're interested in more of our financial opinion, if you want to get access to our model portfolio, see how we're positioning ourselves, which stocks and which companies we're liking in the various sectors in which we're invested, do check out our website. You can become a member for a very reasonable price, and the first month will be half price because we have an early bird offer currently running. So yeah, with that, we'll leave you and see you soon for another video. In the meantime, take care, look after yourself. Bye.